And welcome back. Despite a decrease in mortgage rates last week, applications for home loans actually decreased. This is based on a brand new report from the Mortgage Bankers Association, or the MBA, that was just posted on May 3rd. So in today's video, actually, I'm going to take a deep dive into this more recent report here, can't talk, but also going to be talking about some more early signs of home buying demand so we can gauge where our housing market is headed. And with that said, if you guys appreciate all the analysis that goes into my videos, then please hit the like button. I greatly appreciate that, of course, and also consider subscribing as well if you haven't done so already. I post frequent housing market updates so you guys can make a more informed decision about whether you should be buying or selling a house right now. So with that said, let's go and dive right in. So again, this is a report just posted on May 3rd from the MBA. They say here that applications decreased 1.2% compared to 1 week ago. And this is for the week ended April 28th this year. So of course, applications for home loans is for refis plus home purchases as well. So the refi index increased by 1% from last week, but still down a whopping 51% compared to the same week 1 year ago. Meanwhile, their seasonally adjusted purchase index, which of course is a measure of applications for home loans to buy houses, decreased 2% from 1 week earlier. Also compared to 1 year ago, it's down by 32%. One thing I do want to mention regarding this decrease of 2% compared to last week, it may not sound like a lot, but this cumulative effect of these decreases is quite astonishing here. So look at this. This is their purchase index going back to 2014. So right now, you can see we are at very, very low levels, especially compared to 2020 and 2021, and of course, the first couple of months of 2022. However, though, the MBA's purchase index, when looking at pre-COVID levels, were at the lowest levels going back to approximately February of 2015. So in other words, if we were to look at this as a measure of home buying demand, when looking at pre-COVID levels, this is the lowest levels going back to 8 years ago. Getting back to the report here, Joel Kahn, who's the MBA's Vice President and Deputy Chief Economist, stated the following. Applications decreased last week despite rates declining slightly for the first time in 3 weeks. Now, this is something kind of laughable here. It says the 30-year fixed rate decreased a whole 5 basis points, or 0.05%, compared to the previous week, going from 6.55% to 6.5%. However, though, the reason for this big decrease in demand, of course, is because rates have increased approximately 114 basis points compared to 1 year ago. So what's been happening this year is that when rates fluctuate greatly on a week-over-week basis, that really impacts the amount of applications though. But based on this right here, due to the fact that rates decreased by a whopping 0.05% compared to the previous week, it's not a big surprise that applications still decreased last week. And of course, especially given the fact that rates have increased approximately 114 basis points compared to 12 months ago. He also says that elevated mortgage rates continue to impact housing affordability as well. So here's an example regarding that. And this is a common example I've been sharing on the channel for quite some time. So for someone looking to buy a house for $450,000, putting 5% down, your rate 1 year ago, according to the Mortgage News Daily, one year ago, of course, was 5.5%. Assuming no taxes and insurance, just looking at principal and interest only, just to give you the comparison of the increase in rates, your housing payment 1 year ago would be $2,427 per month. Now, fast forward to right now, again, $450,000, 5% down. Your current rate as of today, which again is May 3rd, is at 6.49%. This means your new housing payment based on that same $450,000 home would be $2,699 per month. And based on my dumb math, that's a $273 increase per month to buy that same house today compared to 1 year ago. And that equates to an 11% increase in your average monthly housing payment based on this scenario right here. What's astonishing about this is that this increase in your housing payment, an increase of $273 more per month, is including the fact that prices are down 3% from 12 months ago. So even though prices on a national level are down 3%, your housing payment just increased by 11%. And that, of course, is due to the fact that rates have increased so much over the past 12 months here. Joel Kahn also says here we have a very low supply of existing houses for sale. Again, I would add an asterisk here. Historically speaking, yes, we have a low amount of houses for sale for existing houses. However, for brand new houses, it's an entirely different story here. And they touch on that right here. It says, however, newly constructed houses account for a growing share of inventory, giving more buyers or giving more options for home buyers. So here's a really good example regarding that, because here's existing houses for sale, according to Realtor.com, as of the end of March, the most recent data we have from them. So as of the end of March, there was 562,000 houses for sale. That's a giant increase of 59.9% compared to March of 2022, which, and by the way, 2022 is right here in yellow. Here's 2021. So we have far more houses for sale compared to 2022, as well as 2021 right here. However, though, historically speaking, as I've been talking about on the channel for quite some time now, we have a very low amount of houses for sale, historically speaking, though, because back in 2017, 2019, as well as 2018, we had around 1.1 million houses for sale. Now we have less than 563,000. Therefore, we have approximately 60% more houses for sale compared to March of 2022, yet we're still down by about 50% compared to pre-pandemic levels. On the opposite end of the spectrum here, for new houses, again, entirely different story here, because according to the US Census Bureau, as of the end of March, there was 432,000 single-family, brand new houses for sale. I should define this for you guys, though, because a new home sale could be a dirt lot in which you place a deposit down, sign a sales agreement with a home builder, and the home builder builds a house. It's completed 6 to 12 months after that time. Or you can buy a house that's under construction, or of course, you also can buy a brand new house that's already completed and ready to be moved in. So for all those scenarios, again, houses that have not yet started, houses under construction, as well as completed houses, that's 432,000 that are available for sale right now in the US. And when looking at pre-pandemic levels, this is very, very high, because we haven't seen levels this high going back to June of 2008. So again, just to briefly summarize here, for existing houses, we're down approximately 50% in the amount of houses for sale looking back at 2017, 2019. Whereas for new single-family houses for sale, again, dirt lots, houses under construction, and completed houses, we're at the highest levels going back to June of 2008. And therefore, no big surprise, a lot of people are moving to buy brand new houses rather than existing houses. And by the way, to give you guys some further clarification regarding this number here of 432,000 brand new single-family houses for sale, here's the data on that. This is based on the US Census Bureau's report that was announced, probably a week or two ago. So again, there's 432,000. That is seasonally adjusted, but not annualized. So 432,000 houses for sale as of the end of March. The vast majority of those houses are actually under construction. So 267,000 out of the 432,000 that are for sale. Now for completed houses, entirely different story here, because we have a lack of houses that are completed that are for sale. 71,000 versus 267,000 houses that are under construction that are technically for sale. So when Joel Kahn says here we have historically low inventory levels for existing houses, and of course we have a growing share of home buyers who are moving to brand new home construction, that is entirely true given the data I just shared in today's video. Joel Kahn also touched on jumbo loans as well, because he says here the jumbo conforming spread, in other words, the difference in your rate for a jumbo loan, which is a high balance loan, versus a conforming loan, that spread continues to narrow. An indication there is reduced lender appetite for jumbo loans following the recent turmoil in the banking sector and heightened concerns about liquidity. The spread was 13 basis points last week after being as wide as 64 basis points in November of 2022. In general, the rate you pay for a jumbo loan, which again is a high balance loan, tends to be a little bit lower for a conventional 30-year fix. So for example, according to the Mortgage News Daily, here is the difference between those rates. So 30-year fix at 6.49%, again for people with exceptional credit as of May 3rd. For a 30-year jumbo loan, it's at 6.15%. So what's happening here is that the difference between these two rates right here is actually narrowing. So this could likely impact those areas in which they see a higher share of jumbo loans. In other words, more expensive markets could be impacted due to the fact that lenders right now are actually tightening their standards for jumbo loans right now. All right, changing gears slightly here, let's talk about Redfin's Homebuyer Demand Index, which of course is an index which measures requests for home tours and other home buying services by Redfin agents. That was down 13% year over year for the 4 weeks ended April 23rd this year. What's really interesting about this is that obviously I've been talking about how the difference between this year and 2022 has been great. But look at this though, because starting in April 2022, which by the way, in April 2022 was the first time we reached 5% rates in quite some time. Remember, the average rate in 2020 and 2021 was 3%. Then by April 1st, let's just call it the first week of April, it reached 5% on average. That was a big jump from the 3% we saw at the end of 2021. And then by early April, we're already at 5%, approximately a 2 percentage point increase in about 4 months. And because that surge we saw back in early 2022, Redfin's Home Buyer Demand Index fell greatly starting in April. And in fact, it fell all the way through until middle of June last year. So it's going to be very interesting to see what happens in the spring and summer months this year, given the fact we're not seeing this surge in rates, but we are seeing sustained elevated rates right now. All right, changing gears slightly again here, let's talk about the National Association of Realtors foot traffic report. This is based on real estate showings across the United States. So let me quickly share February's report here, because for February, home showings by real estate agents showing houses to their home buyers, of course, was down 14% year over year. Also, every region in the US, which is the Northeast, the Midwest, the West, and the South, decreased by double digits. Look at March though, because in March, it actually is worse. So on a year-over-year basis, home showings are down by 16%. The Northeast fell by 25%. The Midwest fell by 19%. The West was down by 18%, and the South fell by 11%. Also, here's a look at ShowingTime.com. They measure real estate showings across North America. And this more or less corroborates what the National Association of Realtors reported for February and March. Because for the most part, in February and March, we had fewer real estate showings this year compared to last year. So for example, for the week ended March 31st, we had approximately 19.5% more real estate showings compared to the first week of 2023. Versus in 2022, that was a 23% increase compared to the first week of 2022. Now here's where it gets really interesting though, because for April 9th, the 7-day moving average as of April 9th, we saw a huge decrease of real estate showings this year, especially compared to last year. This is due to the fact we had religious holidays 1 week earlier in 2023 compared to 2022. That's why I saw a huge decrease in April 9th. Yet after that, compared to 2022, April 17th, a huge decrease because this was Easter holiday here. Look at this though, because after the holidays though, we've been seeing a decrease of home showings in 2022 compared to the first week of 2022. But now we have more real estate showings right now compared to last year. So for the 7-day moving average as of May 2nd, there was an increase of 26.8% compared to the first week this year. Compare that to an 18.7% increase we saw back in 2022. I was actually really scratching my head regarding this morning when I was looking at this report here, because to me, it doesn't make sense we have more real estate showings this year compared to last year, at least compared to the first week of each of those years. given the fact that rates are around 6.5% this year, and 1 year ago, of course, rates were in the fives. The reason for that is this right here, the giant surge in rates we saw in 2022. So for example, in 2022 or 2020 and 2021, rates were hovering around 3%. Then January hit and rates absolutely skyrocketed until we hit the end of October last year at 7.32%. So in looking at this chart right here, for the 7 days ended May 2nd, back in May of 2022, which is right there, rates increased to 5.5%. Now keep in mind, that would be a great rate today, but compared to 2020 and 2021, that was a 2.5 percentage point increase, which is insane. In other words, the surge in rates we saw in the first half of 2022 absolutely shocked the market, and you can see that in the data right here. We're looking at showings ever since really the end of April. Real estate showings in 2022 absolutely fell all the way until the end of the year. Now, not to say we have some challenges in our housing market today, but last year during this time was entirely different compared to what we're seeing right now. What I mean by that is that average rates for a 30-year fix have been at or above 6% ever since September of 2022. So we're no longer seeing this shock that's hitting our market where rates are absolutely skyrocketing, going from 3% in late 2021 and surging to 7.3% by the end of October that year. So to summarize today's video, the index based on applications for home loans to buy houses based on the MBA decreased by 2% last week, but again, it's down by 32% from 1 week ago. Also, the current levels right now, we're looking at pre-pandemic levels, are at the lowest levels going back to approximately February of 2015. In other words, we have a lack of home buying demand, historically speaking. And of course, the reason for this is a lack of housing affordability, as home prices have been increasing this year, and of course, rates have increased greatly compared to the past couple of years. In fact, for someone buying a $450,000 home, putting 5% down, they're going to pay approximately $273 more per month, or 11% increase in your average monthly housing payment compared to 1 year ago. Redfin's also seen fewer requests for home tours by their agents, again down by 13% year over year. However, according to the National Association of Realtors, home showings for all agents is down 16% year over year for March. But having said that, it has changed according to showingtime.com ever since April this year. In fact, we have approximately 27% more real estate showings in North America compared to the first week this year. Compare that to last year, we were up by 19%. And with that said, check out that link below if you guys want a real estate agent referral in virtually any parts of the United States. Of course, if you guys got any value in this video whatsoever as well, then please hit the like button. I appreciate that. And of course, I appreciate you. Hope you guys have an awesome day. I look forward to seeing you on the next video.